Very good afternoon. I think let me start off. I know it's going to be a post-lunch session, so let's get our energies back. And my challenge is to keep all of you engaged for the next 20 minutes. The core strategy of retail assets. Okay, a quick sense of why this is important is because for anything that I speak from the next slide onwards, it's important you understand, or all of us on the same page, that these three tenets are extremely important when we do business. The first, in today's environment, digitization. So I'm going to particularly spend time in the two products which we are very excited about this financial year, the 10 seconds open market product and express car loans. Then I'll cover the pricing strategy of the bank, which is consistent over the years, and why it holds significance for us when it comes to probably treat it as a bank worth investing. And the third most important is the portfolio quality that we keep, again, very consistent throughout. Let's look at the first, the digital part of it. Other than we believe that we're paradigm pioneers. Basically, what I'm saying is that we've in-house produced, solved customer issues, created customer conveniences, and with that intent at the background, created products which actually made a competitive advantage for us on the business side. If you look at the first in the industry, digital platforms that we've done, you look at the 10 seconds PL, new to bank, which is coming up by next month, the express car loans, the digital loans against mutual funds that we launched, the digital LAS, auto loan zip drive, the 10 seconds PL, and we're constantly innovating. Let's quantify that in a more detailed manner. If you start from the top, by next month, we're feeling confident enough with our analytics, our risk management strength. That's the core to all these products that you see. It's not the digitization that makes a cutting edge, but as a bank, you need solid amount of analytics and risk management behind this to pull this off. Around 6 to 7 years ago, we launched the existing 10 seconds loan. We are kind of very excited that by next month, we're introducing the open market 10 seconds loan, where you can actually go on the Google and the credible customers can not only get it approved, you'll get it dispersed in your account. So that's the kind of strength and platform that we're confident of. We will build it step by step. But the fact is we're initiating that journey, same as we had initiated most of our journeys. Couple of months back, we started express car loans. If you look at express car loans, we're extremely excited. It took us almost 2.5 years odd to actually connect the dots and hit the ground running. Today, the situation is that the complete digital piece is close to around 20%. And we have all the reason to be excited because it's across all touch points. It's across dealers, it's across online space, it's across digitization, everywhere that you can touch in the bank, whether it's telecalling, whether a person just types that he wants a car loan and he starts from there. And if you look at the data, 90+% people actually first type when they're looking for a car or looking for a car loan. But the opportunity in the market is not even 1% before this product was launched. This can handle it end to end, can process it. Again, the strength, I would still attribute the strength of the USP or the premium quality is our quality to assess customers seamlessly. Whether it's analytics, whether it's various technologies that we are inbuilding in it, whether it's our ability to assess our internal customers, from those learnings, we've reached levels and scorecards that we can actually assess through algorithms external customers through their cash flows. If you look at every passing year, right from 2015, 2016, 2017, 2018, 22, 23, and there was a COVID period in between, we have consistently, all these, none of them are Me Too products. They're none of them that somebody else launched and we said, I think we got to do the catch-up. If you look carefully, every single product, the team sat through it, went across to compliance, went across to risk management, bottoms up. Couple of times we took the help to talk to the regulator to see whether we are walking a road which we can pull off. And this is completely for a scheduled bank, bottoms up. So all these products is the strength that the bank holds today. That's the reason I started with this slide, because just to give you a big picture that, I see a lot of players in the industry talk of being digitization, but I don't mind sticking my neck out to say on the retail lending side, we can with fair confidence say that I think the teams are fairly innovative, and I think between inter-departments, the cohesiveness is truly the output that you see on year. Just 60 seconds on the express car loans, because it's already reaching a very, we have around 52,000 customers, dispersed 4,800 crores. It's an encouraging start for us. We are looking at targeting new to open market customers, so they can also be customers which are not account holders of the bank. So just imagine, just to give you an example, you could be banking with any public sector bank or private sector. You could walk into any of my branches and they will effectively can open your account and actually process a car loan for you. So you could be like semi-digital, virtual, without putting a name to it, but an ability or a strength to process car loans for anybody in India, across board. It's an end-to-end platform. So you can actually, we've authorized some 4,000 dealers, if I'm not wrong, and a whole lot of them you can just go choose the car you need after you've test driven, choose the dealer you want, actually select it, we'll process it digitally, the money will get transferred to the dealer, and the whole process will go seamlessly. So it's a zero paper, zero touch in 30 minutes. There is a video KYC option if you're not an existing customer. Then that option has to be activated. The bank statements through account aggregator takes 2 minutes. Our technologies to assess these statements has reached a level where we can probably seamlessly process it. You have approximately, in principle, around 5 minutes, the same day dispersal. So the whole idea is that can I give confidence for a complex business like this? I think the answer is we are excited to say that not only can we give, we are nearly reaching 18 to 20% of the business in this flow. Now, our next journey on this road ahead will be, say, co-applicant journey. Once we get that right, that should probably add around 25 to 30% plus incremental business on it. Because if you look at the auto industry, on the lending side, around 30-35% of the business happens to be co-applicant journey, all of you know. So I think we're excited about our next step there. Look at the next vector, which I said. The first was the digitization. The second is pricing for risk. Almost in every product, significant contribution from customers with a bureau score of 760 and over. And we do prudent pricing is the message I wanted to leave. Because our target audience, while we may get the first right to refuse at most of our distribution points, the important point is that we are targeting a certain quality of customers, keeping the growth trajectory in mind. We are not looking at growth trajectory with any slight borderline compromise on the risk as well. So our digitize doesn't compromise risk, our ability to grow doesn't compromise risk. If you look at the quality of sourcing here, we've indexed it so that you don't want to give, you can't. So if HDFC Bank was 1 in terms of the bureau quality that we're picking up, you have private sectors at around 0.85 and rest of industry at the figure that I'm showing. These are all figures available with the bureau. So these are the things which probably I felt was important as a business to represent when you guys assess the differentiation between the quality of assets that are getting created between different banks. Similarly for auto loans, similar pattern you see in loans against property. So it's pretty consistent across as a philosophy ethos, and it's executed right through. If you look at the quality portfolio, if you look at the delinquency, if you cut it from a delinquency angle, we are among the lowest in the industry. At times, we feel confident to say that we probably are nearly half of competition in spite of the concentration of the unsecured book. Presently, all of you are aware that we have a fairly large portfolio of the unsecured book contribution. But not only is the unsecured book doing extremely well in terms of their delinquency and quality, but our figures are nearly very, very competitive compared to competition on the delinquency as well. And despite that, we are near market leaders in most products, and we maintain a growth rates a notch higher than the market industry. That's the philosophy that we go through. If you cut this data from a delinquency point of view and you index it, you can well imagine that the low is high quality. So in this, if the index is 1, the market is running a delinquencies of 1.8. And if you look at auto loans, a 1, 1.3. If you look at a loans against property, that's again interesting. It's a 1 against a 2.1. So that's the kind of pattern that the business gets done in. I'll quickly cover a quick sense of these three businesses. The mergers around the corner, so the home loan. I'll cover an aspect on the gold loan, and I thought maybe give a little bit on personal loan. It's a one slide I prepared to give you a quick sense on the merger. If you can, we can take it through step by step to give you a sense. The fundamental philosophy on the merger was leveraging on the mutual strengths, which basically means when HDFC Limited merges with the bank's philosophy and direction is very clear. We would want, and we've put in hours on this, I can assure you. Entire team of the bank has put in hours on this to retain the strengths of HDFC Limited as much as possible and capitalize on the strengths of HDFC Bank. So we are not, the aim is to build both the strengths as the merger progresses. Let me quantify that. For example, let's understand the strengths of HDFC Limited and the bank, and I'll give you what the net result can be in the end. You have a stronger builder relationship. The bank's not been working with the builders, is a well-known fact. HDFC Limited is known to be extremely strong there. So we will capitalize on a known fact. They are known for their robust process and policies. We are looking at maintaining a distribution where the customer faces and picks up his check. Today, most products that HDFC Bank does, we actually go home and process it. We're retaining the HDFC Limited strengths of actually facing the customer at the counter and optimizing that through digital and cross-sell and the power of bundling. Large customer base, HDFC Limited branches are very, very robust and well-placed. Best-in-class legal and technical diligence. We will retain all these strengths, combine it with the rich strengths which HDFC Bank brings. Rich customer database of salaried and self-employed. If you add this with our analytic strengths of creating pre-approved base and offers to our customers, which you can give post the merger, this should unleash a new strength on our customer base. Corporate salary, if you look at HDFC Limited, they never focused on corporate salary the way a bank focuses on corporate salary, where multiple teams, including your corporate banking, including your liability teams, including your asset teams, are constantly working on. There's a whole segment getting added for us to kind of penetrate in terms of pre-approved offers, including visits, including mixing it with builders. Then we're looking at customer life cycle with multiple product offerings, whether it is on the lending side, whether it's on the liability side. Can we create a bullwhip effect there with our existing cross-sell strengths that we have? Our biggest strength, HDFC Bank branches and open market distribution. If you look at both these elements, the bank has fantastic branches, a well-oiled machine, working on seamlessly like a clockwork on the cross-sell model. Parallelly, if you look at the open market contribution, if you look at our lead product, which is personal loans, and if you look at auto, they have the most amount of relationship over the last 2 decades with distribution. And these guys are a direct leverage, even for those who do home loans. So HDFC also does, we also participate in it, but I think that gives a further lift with our multiple product relationship with the distribution. And of course, risk-big analytics with algorithm. If you saw my digital slide with the kind of risk and analytics strength that the bank adds, I think both the companies have brilliantly same value system with different cultures. I think if you can add these two strengths, I see some of these coming out as low-hanging. Turnaround times. I think bank is very, very focused on turnaround times. I see this output coming as quick sanctions, enhanced corporate relationships. I see a huge amount of pre-approved offers for our liability customers. I see a huge strength of higher productivity there kicking in over a period of time. I see managing customer life cycle with multiple products. A single product company moves into multiple products, both for assets and liabilities, even if he's got to pay his bill pay, even if he's got to digitally we can upload his HDFC Securities account, his DMAT account, his lending businesses, his top-up loans. Imagine the scope here substantially unfolds in our limited view to a massive quantum here. If you look at the increased distribution network, it's massive, both for liabilities and the assets that we leverage. And of course, the quality of portfolio. Today, I think, if I'm not mistaken, around 60+% of HDFC customers don't have a liability account. Post-merger, our plan is that every guy will have a liability accounts and pay his EMI from there. And the whole plan is that we encourage that whole liability to lead to customer life cycle and power bundling unfolding. And that, if you see for all our products, if I can take a minute, and that's just my hunch, personal experience hunch, if you look at any of our products, and if you look at whenever they've opened a liability, you yourself can guess what the quality of delinquency was as the pattern started unfolding with multiple life cycle. So I'm optimistic here on that as well. So these are the broad, quick sense of how it should unfold. Personal loan, just a line or two to say that we are consistent, we are focused on this business. 3 to 5 year vision, we don't give any guidance, but I think these are the 5 to 6 tenets that we are focusing on. The first, of course, what we're excited about, building on the 10 seconds loan, which is going to launch on the open market side. I think there's a fair amount of quality play there with zero compromise on the risk. So we will move step by step on it. We are not going to unfold the whole world, but like every digital product that we do, we will be prudent as first and digital thereafter. Loans to the government employees, I think, is a big target segment for us. The entire bank is building on it. There's a direct synergy with the branch which is working on it. There's a direct synergy with assets that's trying to work on it across the bank as our next growth vector. Corporate salary segment, I think, is always a very rich base for personal loans. Focus on the digital unassisted business. We've started kicking this in a big way, considering that this is coming up and our interaction with the customer becomes far more seamless. If you look at the pre-approved offers, even this is a new avenue that's opening up for us. Imagine 30,000-40,000 dispersals a month on housing. And you can actually, that's a completely new avenue for unsecured that happens. Does it kick in an extra ROA? My optimism says yes. We see it as an opportunity. Bundling for home loan customers on both liabilities and assets is going to be, appeal is going to be a big factor in it. A quick last word on the gold loan side. I think I had last time presented that we are beefing up the distribution to 3x. We are looking at close to around 4,000 active gold loan centers across. If you got to strengthen, as the bank starts consolidating its strengths on the rural and semi-urban side, which I'm sure a couple of my colleagues touched upon. So treat this as an additional strength that's coming in. So it's a leveraging on high distribution strength on that side, and especially it has the lowest delinquencies, or rather nothing. It's just the fraud control risk. So it's a much easier product to ride on that wave. It adds value to your PSL. So on the rural and semi-urban side, as we start proceeding ahead, I think we see this as a strength unfolding. Thank you. Any questions? If at all. Yes, sir. I think, see, 60-70% don't even have a loan, don't have an account itself. So it'll be a very small proportion.
Don't have an account with the bank?
Yeah.
Okay. No, so say for example, there are 5 million customers of HDFC Limited who have taken a mortgage loan through HDFC Limited. You are telling 60-70% don't have their EMI passing through the...
There was no stated policy to open an account in HDFC Bank.
Correct.
For them to do mortgage.
Correct.
All I'm saying is now, as we go for the merger,
correct,
the plan is we're going to have everybody open a liability account and open up all the bundling options with it.
But can you force them to move, say for example, they have an account in Axis and an auto debit is happening through Axis Bank. Can they change it, or compulsory you will ask them to change it through HDFC Bank?
No, I think I'm talking about incremental business, Suresh. I'm not talking about existing portfolio. Yeah. Existing portfolio, we'll have to talk to them and see how it moves.
Okay, on the exit.
But our effort is going to be to encourage them.
Okay.
And it's going to be more a discussion item and see how it moves, because we are going to respect the identity of where they are right now, in whichever form we are accepting them.
So in existing portfolio, you're saying 70% don't have an account with HDFC Bank.
We will be talking to them and trying to move in that direction. Okay. Incrementally, I'm saying we will try and encourage most of them to be account holders.
Okay. Okay, so that's clear. And the second question is how geared up you are for the merger. Say on July 1st, the merger happens. The mortgage loans will start happening. You are very well prepared. The sales agent on the force, on the field, everything is pretty much integrated well. And yeah, just something on that.
So I think there's a fair amount of institutionalized work we've been doing for the last couple of months. There's an integration committee in the bank that's constantly reviewing it on the business side, on the credit side, on the ops side. Each piece is getting stitched so that it happens seamlessly. Like I mentioned in the housing side, the aim is to keep as similar as the way HDFC is and add the strengths of the two parties together, and that's the whole aim. We're not kind of making another HDFC bank out of it. The whole plan is to kind of build strengths on both the parties, because it's been a fantastic franchise, HDFC Limited, and I think it's important for the bank also to absorb and learn and mix the strengths. So that's going to be the whole plan, Suresh. And we are ready. If that's what you're asking, yeah, step by step, we are pretty much ready.
Chintan here from Autonomous. If I think about the various segments within retail assets, which ones do you think can grow above the group's growth rate? Which one do you think would be below as you look at the marketscape for the next couple of years?
Which one can grow above what?
Above the group's growth rate. So which one will you grow faster than the group, and which ones would grow slower than the group?
Which ones see opportunity, you're saying,
Yeah.
in terms of retail lending?
In terms of retail lending. So
No.
of the different segments, personal, auto, gold, like, where do you see the opportunity to grow faster than the group?
Yeah, I think the very first is the merger product. I think I see a very big opportunity on the housing side with the kind of focus that we're putting in. I think it's going to be a very, very, at least I can say with fair optimism that should be there. I think unsecured continues to be a sensible, prudent lead product. I see that happening. I think we've introduced gold, but remember the portfolio of the gold is very small. So it's not going to be impacting the size to that extent. It's just that I'm saying we're directionally moving in that direction. But if you look at home and PL, we're looking at big. I think loans against property for the last 2 years has been growing substantially high with very low delinquencies. I think I expect that growth rate probably with no guidance running in our optimism is high, let me put it that way, on that. So.
Okay, and the second one is, you showed a slide with 4,800 crores dispersed through digital auto loan. So if I think about the different segments, how much is being disbursed digitally with that kind of, 10-second kind of philosophy? And where would that number be on a few years down the horizon?
See, like products like PL, we've reached close to around 30%. If you look at auto, we're just about 20%. I shared with you that there's a whole co-applicant journey underway as our next step. And we always take a step at a time. We don't rush it in. Once that comes in, that piece in the auto loans compass itself is around 30-35%. So I'm expecting once that journey comes up in the next 4 months, that should probably add value in terms of this 18-20 going to probably a 40-50% of auto loans fully end-to-end digital.
And the remaining would be kind of
still
branch,
physical.
Yeah.
It's going to be a constant journey for us to do it, because I think we have the confidence now, open market customer, we are far, far more confident of assessing him with the kind of analytics and technology we had. And that's the leapfrog, I think, which probably I was talking about when I said digital. Because most of these digital products, the only constraint we have is that you've got to be prudent risk. Because otherwise, capability-wise, they can all be running very high. If you look at loans against shares, loans against mutual fund, we're close to touching 80% already.
Thank you.
Okay, Arvind, the question here on asset quality, it's been like 24 months since COVID happened, and industry's grown pretty well and recovered out of it. Just wanted to understand what signs you look for, because there was some tightening that happened during COVID. Have we fully relaxed that back to where we were on standards or across the industry standards pre-COVID? And what signs did you look for to say that yes, now it's been some level of growth where the standards need to tighten again?
See, banks always been consistent in the way we look at things over years. I think we are already running delinquency levels far better than pre-COVID levels. That I think you may have heard since morning. I think that's our situation right now. But that doesn't mean we open up anything extra beyond what we see as risk management. And that's the way bank works. So bank believes in a certain process of assessing cash flows, instability. We look at certain quality of checks that we do. We have confidence in the way our past repayments of customers are, and these are the three tenets that we never compromise. And we're going fairly aggressive on adding technology for our assessments. Today, probably we can assess bank statements far better than we ever did. Today, I think our PDFs that we are uploading, our ability to assess unstructured data to put it in some form of structured data is substantially better. So there's a fair amount of value that we're adding there. And I think we're pretty consistent. So if you're expecting that because our delinquencies are lower than pre-COVID, are we going to open up risk beyond what we normally believe should be our cutoff? The answer is we'll be consistent with where we were pre-COVID. So I think where we're adding value is substantial amount of our knowledge is helping through algorithms to assess digitally. And I think that's adding a competitive advantage in our entire game plan. Because then the productivity kicks in. Then you can start moving the next case faster. And that's where the cycle starts adding value.
So now you all don't expect, like in the very near term, let's say a couple of years, since you said delinquency levels are lower than pre-COVID, at some point it normalizes or it gets competed away, right? So where are we in that cycle?
No, I'm not very clear on your question.
I'm just saying you're running very low credit costs, right? Vis-a-vis where you were pre-COVID. Either you'll compete that off in the market or, delinquencies go up at some point. I'm just trying to understand, do you see any signs of that yet?
See, if you look at unsecured, I mean, for the last 7-8 years, I've been hearing cycles are going to go, bust. But if your consistent quality is 90%, you have liability account holders that you're giving it to, whether it's inside or outside, and you have a certain way to assess customers and you don't over leverage a situation, I don't think cycles really change too much in granular, small tenor, shorter ticket size loans. That's my experience. This used to be earlier before the bureaus came in, where you had this whole cycle and the whole cycle would turn on its head. But if you see from the last 10 years, as the bureaus is coming in, they've added immense value in terms of, for all the institutions who were lending. And I think the cycle patterns have changed. Yes, please.
A couple of questions. Just extending from the previous question. Typically what we have seen is any product where there are more number of lenders, either already present or going into it, either the economies of, unit economics takes a knock or some asset quality episode happens. What has been your assessment so far? And it is interesting that you launched the new to bank in 10 seconds, and this product has been around for the longest time. So when you launched this, what has been the thought process? What kind of consumer cohort are you looking to, target for this segment?
No, I think the very fact, if you look at our 10 seconds loan, we launched it 7-8 years ago. And we've launched this product, we waited for so long. So it is not a capability to launch issue. It was a confidence to launch issue with zero compromise on the risk that we pick. That is the gap. So it is always constrained, the equation is constrained by the quality of risk, because the idea is not to compromise risk and get your digital right. That's not the way it works for us. So I think we are pretty confident on the 10 seconds open market, but we're not going to go berserk from day one. We will keep testing boundaries, and then you'll find within 6 months, 1 year, we'll get far more confident, and then we'll open up a league again. So it's not going to be incremental growth, it'll start gradually, and like every other product, when we launched the 10 seconds, we never touched the business loans. But today we do business loans 10 seconds for our customers, purely without only on bank statements and PDFs assessments, and a fair amount of scale. So similarly, this which we are launching is not for PL alone. We are launching open market for business loans also. Okay. Yeah, entire unsecured, not just PL.
And of this, how much would be, let's say, NTC types or,
new to bank type.
New to credit customer types?
Oh, that's a difficult one. I mean, often, even if they're new to customer, if I have visibility to their banking history, I think I can fair confidence we can assess them and give them a loan.
And this has been enhanced by the availability of account aggregator kind of frameworks?
Yeah, all account aggregators. And if we get visibility, because also customers are fairly confident on sharing, in our platform to get into the account aggregator. And we have that visibility. Like I said, we're using a lot of technologies which give us great clarity. And our experience of connecting the dots on scale that we ran 10 seconds, that we have fair assessment without the Form 16 as well, how the patterns of customers fall into what delinquency brackets. And I think that's pretty similar for open market as you walk that road.
Just one last follow on. So in terms of, let's say 2-3 years out, if this, takes off well, could it be a meaningful part of our composition? And how's the economics you guys are working out? Will it be similar to the existing 10-second personal loan for the ETB customers?
No, I think in 10 seconds, the existing customer loan is a great economic product from a business point of view. Operating cost is fantastic from a business point of view. And I think 10 seconds open market, if it takes off the way we are envisaging it to be, 2 years later, 2.5 years later, it will add amazing strength to a product like unsecured. And I think that's, as also the younger generation gets far more digital, digital is not really an option left in terms of just being smart. I think it's getting more into need-based. And as the young guys are 20 plus guys getting into jobs, I think a lot of them probably may not go through intermediaries. Maybe the world changes on that. We expect that pattern to change. We'll want ourselves to be ready in the next 2 to 3 years on that without compromising risk.
Hi, one question on the bureau score benchmarking of personal loan slide, if you can refer again, then we showed that other banks and industries like 0.65 versus 1 for us. So what is really causing this distortion? Because if I look at the larger banks, they are all reporting very strong asset quality and they're writing to their internal customers. And wherein ICICI Bank reported a negative core credit cost in FY23. Likewise, SBI also has a very pristine asset quality ratios on the express loan book that they have. So why is there the divergence being so high versus 1 and 0.65?
No, we are saying that ours is substantially better than the bank's name you took.
But it is not reflecting in the asset quality numbers as of now.
You dissect it, it will reflect. I won't have presented if it's not sure.
Sure.
No, this is public data. You can get this data. I'm saying on retail lending, on specific products that I showed you, LAP, PL and auto, we're significantly better. It's just a professional statement. I'm not saying they're good, bad, I'm not commenting on them. I'm sure everybody is making the best effort to do it, but if you slice it, that's the way it is.
Right, thanks.
Hi, Arvind. Over here. Yeah. Just a question on this unsecured lending to government salary accounts. What's your market share over here? What is the share in government salary accounts that you have to whom you can cross-sell? And what's your growth strategy and what can this be like 3-4 years down the line? Thank you.
I think government salary account, I think our penetration both on assets and liabilities is something which I think the entire bank's working on. It's not exactly our biggest strength area in terms of the way we've done it over years, because we've been very prudent wherever we've opened our branches, and we've always had a strategy as a bank to open it step by step, but we're moving at a much faster rate. And on the lending side, PL is also adding value in terms of the first product to open the doors in the government, because it's a much faster moving product, and especially with digitization, you can move much faster. And I think that's where it adds value. So it's a very high focus product for us. But of course, we'll do it prudently as to what rate of growth we want to grow every year.
Got it. Thank you.
Sir, hi. Similar questions to what has been asked earlier. So if I look at SBI Express loan book, and that is roughly double your size, and they claim to do it more or less entirely through government salary account, government employees. So while you said that you are focusing on that segment now, are you not already late into the to joining that bandwagon? And what is your sort of right to win in that segment cohort?
I think first of all our brand. I mean, you can ask the same question for housing too. We're merging at this stage. So we obviously, our processing abilities, we launched the 10 seconds much earlier to them. SBI is known to be a very good strength area on the government side. It's been historically focused there. Their objectives, our objectives, we are substantially investing on the government side right now as a bank. You have specific verticals that are focused on it, but bank obviously has multiple criteria, ROA, ROE. There's a whole bank that moves in a certain fashion. You can't just get it right in one piece. So I think our wherever we have seen and done constant 1:1, even with the bank that you named, we've had very good and very encouragement response from the government employees as well. There are pockets, by the way, in the country where we are lead players And we've almost picked up that particular government in that complete state, leave alone a city, where we worked on. So I think the work is in progress, and our initial feels in multiple pockets of the country seems extremely bullish and encouraging. I think it's the brand, it's the way we service customers, it could be an aggregate of multiple things. Fully respecting the bank you're talking, but I think we're getting a huge head start there.
Thank you.
So, a question on mortgages.
Yeah,
so, a question
sorry.
on mortgages. So, as far as the tech integration bit is concerned, so an HDFC Limited and HDFC Bank, the core systems might be different in terms of how they're designed. So, how would the tech integration look like post-merger? And what are and does that have any effect on the OPEX bit in terms of the cost to do any incremental business? Would the maintenance of tech systems be pricier post-integration?
I think I have a full IT presentation, which,
Specific
yeah, I
to
think
mortgages.
your digital
Specific
head
to
is looking very confident to handle that full on with you.
Okay, all right.
Yeah, but I think overall the business will look substantially viable in my limited sense. But specific to your tech question, I think just reserve it. He's the right man to answer. Thank you so much. Yeah.